So the top 5 reasons why retail traders fail. Poor or no trading plan. Most of those traders that I was referring to, if you ask them for a detailed description of how they trade, I haven't heard a single one be able to tell me in detail what their trading strategy is, or when they trade, or how they execute entries and exits, how they manage a trade. Just they don't know. They operate on gut instincts or follow the herd, and rarely are they consistent. Number 2, lack of discipline. Discipline is so important because, as we'll explain later in great detail, it keeps emotion out of the process. And psychology plays a huge part in trading. We're all going to experience losses. So let me save you that suspense right now. You will have losing trades. I have losing trades. We all have losing trades. Sometimes we'll have a lot of losing trades in a row. Discipline is such a major thing in trading, a vital component of success in this trade skill. Number 3, poor trade management. We'll get into a study that was done by FXCM in a little bit, but poor trade management is sad because you could have a great strategy and enter the trade right, but from there you've got to manage that trade correctly in order to consistently be successful. So this one, is the one that makes me perhaps the most sad. I'll look at traders' trades and analyze them with them, and I'll see that they entered correctly, but from there it just kind of was willy-nilly, just flying by the seat of their pants, and they end up kind of screwing up the trade. So polishing that up is also very important. Number 4, cost of trading and execution. That's a big one too. Depending on your frequency of trades, trading costs, commissions, fees, and even spreads can eat up a lot of your capital. So keeping that in mind is very important. And being undercapitalized. That is probably one of the major ones. Like I said, they have accounts $500, $750. A good trader, a great trader, let's say they make 100% return. So their 500 goes to 1,000. Did that change their life at all? No. And I'm exaggerating there because 100% return is very good, and a trader that can do that will have had to study and get good at this. Well, what's the point if all you can do is make $500? That didn't change your life. That just, maybe it made a car payment one month. Now you're back to square one. So these are the 5 major reasons. So let's start with trading plan. What's the purpose of a trading plan? Well, this will basically be your go-to manual, operating manual for how you trade. And what's important about it is that it's backed by all your practice, all your simulator trading, all your back testing. It involves everything that goes into what you're doing in a trade, from entry to trade management. When are you going to take profits? When are you going to add to the trade? When will you exit the trade? When will you be trading? What session? A lot of people like different sessions, the London session, US session, Asian session. So You need to know exactly how you're going to operate and have it written down. That way, again, it takes emotions out of all the decision making. And if you've never traded before, trust me, emotions get involved. Personally, I hate losing. I do not like losing. So earlier in my trading career, I I almost would refuse to let a trade take money from me. And I would do what's called revenge trading a lot. And I'm telling you right now, do not do that. It will multiply the loss you would have taken by a big number that you don't want to know about. So yeah, have everything written down. And as long as your trading plan is founded on all of, like I said, all your back testing, all your practice, what you're good at, and emotions taken out of it, follow it. Trust yourself. Trust the work you did getting to that point, because the numbers will then work themselves out. So what needs to be in a trading plan? Well, like I mentioned, basically everything about a trade that you're going to be executing. So you've done your analysis. You pre. This is all conceived here. So entry criteria, trade adjustments, execution. How much capital will you allocate to each trade? What's your risk tolerance in each trade? So capital allocation, position sizing to size for risk, max risk, and then your exit criteria. This all needs to be written down in your trading plan. So this is the FXCM analysis that was done. One of the largest studies that was ever done over these topics. And FXCM analyzed 43 million trades over a 1 year period. That's a massive sample size, I'd say. I've never done any research project where I've looked at 43 million data points. But what they found was the traders were actually pretty good traders. Total win-loss percentage was 59% to 41. So 59% of trades were winners, 41% were losers. But here's the catch, and this is why they looked deeper into it. Accounts that were profitable, only 17%. Well, how's that possible when 59% of the trades were winners? We'll get into that. But the summary is traders are right more than 50%, according to their study, but they lose more money on losing trades than they win on winning trades. This is what we call the profit factor. So traders should use stops and limits to enforce a risk-reward ratio of 1-to-1 or higher. This is so important. One thing we teach is let your winners run. If a trend is working, let it continue working for you. If your trade is not going to work out, stop it soon. Don't let those losses get big. Because I don't care if you're a 90% winner. You have if you take one loss and it's sizable, it can wipe out all 9 of those winners. So your profit factor is the other half of this puzzle that will determine if you're successful. To keep going with that, they looked at the profitable trades by currency pair, and you can see so you can see that the regulars, pound crosses are pretty popular. Now, euro crosses, pound crosses, dollar crosses are usually have the tighter spreads. So, of course, those were, and yen crosses as well. So, this is no surprise for me to see here. But then, this is what they found. Percentage of trades that closed with a profit. That's up here. Average profit and loss per trade. This is where that profit factor comes into play. So you've got the Aussie Kiwi. 71% of these trades closed with a profit. But let's find it down here. Okay. Average profit and loss per trade in pips. So yes, 71% of the time, on average, the traders made 61 pips. But the other 29%, they lost 90 pips. That's bad. That means their profit factor is less than 1. In fact, it's about 0.68, I would think there. It's a little over 2/3. So, and euro dollar, one of the most widely traded pairs out there on a day-to-day basis in this $7 trillion a day market. Look at this. So euro dollar up here. Let me get my little pen. So let's see. Here's euro dollar right there. Wow. 59% were winners. But then we go down here and we realize that the profit factor was about 0.5. So it really doesn't matter if they won 59% of the time. They're losing almost twice as much as they're winning. Losers are losing almost twice as much as the winners are making. So this is going to need to be a lot higher to account for that horrible profit factor. So something to think about. And if you want, I embedded the FXCM study. Just click on this image and you'll be taken to it. Very fascinating read, very good stuff to learn and know and put in your trading plan. Lack of discipline. This picture cracked me up, so I put it in, but he's trying his hardest not to get those those marshmallows. Discipline is so important in trading because emotions get involved. Look at him. I mean, it's all he can do to not just grab them and shove them into his mouth. But it's very hard when you are doing something you hate or that is unnatural. That's why we have this personality assessment that we make all our traders take. It's for you. It's to help you understand you. What difficulties are you going to face as you're trading? Just by the nature of who you are. It's easy when we're doing something that we like or that comes naturally to us. We need to know what we're naturally good at and what are the pitfalls that are going to come, because we all have them. Might as well know them. Our personalities dictate what we can and can't do easily. We need to know about those. Position management. I put a couple obvious things here. We want to win, make money. We don't want to lose money. I'm not sure if any of you didn't know those things, but just in case. A quote that I love is, play to win, don't play to not lose. Like I said, I'm very competitive. I get very emotional. It's just part of who I am. I've had to really learn how to curb that when I'm trading, because I've taken losses and I've had losing streaks, and that will make you become more of this type of person. Don't play to not lose. I was playing to not lose at that point. I was almost scared to make trades. Again, follow your trading plan that's taken you, hours and hours, hundreds of hours to put together, and it's been proven to work for you, and the numbers will work themselves out. Don't be afraid to trade all of a sudden. Now, I know that's easier said than done. I remember at the time I told my coach that I don't even want to touch my computer. I'm afraid that everything I touch lately is a loser. becomes a loser because I touch it. It's not true. Losing streaks will happen to all of us. Play to win. Manage the trade the way you always have been, the way that worked when you were building your trading plan, and everything will work out. So I just want to put an example of, trade management. So I do something called legging in, which seemed counterintuitive to me because of my background before trading. But I add to trades, and I actually leverage into them as they go working for me. So that's just in my trading plan. I'll enter smaller than I usually would when I first started trading, and that's because I kept getting stopped out of trades early, and then only to see it, turn and go the way I thought it would. Those are hard trades to watch. So what I do is I go in smaller to make sure that yes, this is a trade that's going to go my way. And then I pick certain spots along the way to what we call leg in, or add to the trade. So that's something that's involved in my trade management. And then we also have a spreadsheet that can keep track of everything for us. Mainly, I included this spreadsheet that you can download on the site to make sure we're keeping our stop loss at least where it says we need to have it in order to comply with our own individual risk metric. Now, mine is 2%. Sometimes I'll have to adjust that when doing an assessment or trading with another prop trading firm's capital, because sometimes they have a very tight trailing stop loss that will boot you out of the account. So it's going to mean less latitude as far as the downside. So you need to adjust that. Anyway, this is in the website, but you can see that my trade management, I could have just entered the once and then exited when I did. But by levering in, you can see that legging in for me is a good way to avoid being stopped out too soon and make sure the trade is going to go my way. And I usually end up making a lot more than I would have had I just done the simple entry and exit. So trading costs can be expensive, and if you click on this on the image here, it'll take you to a website that you can compare different brokers on their trading costs, commissions, spreads, and all those things are very important. Very, very important if you just have a tiny little account. But we do provide our traders with meaningful capital. So as a percentage of the account, it's going to be less of an issue, but it just depends on how much you trade. We have people that trade on the daily chart, the monthly chart, and then we have high frequency traders, scalpers, that are trading on the 1 and 3 minute charts. So obviously that latter group are going to be more concerned about spreads and trading costs, because they're going to be about 100 times the number of trades with them as say someone that trades on the monthly chart. Trading meaningful capital. This is key. Now, like I said, the analogy I used, someone that has $500, if they double the account, which only a really good trader can do all the time, well, it's not changing their life. But imagine if you were given 100,000 in your capital account, which is also levered. Let's say in the US, the cap is at 50 to 1. So now you've got 5 million of tradable capital, which the $500 would be 25,000. So you've got to, I mean, just right there, you can see, let's say a 1% gain. Well, a 1% gain, let's assume you were fully levered, which I don't recommend. Uh, why would we want to do that? Fully levered though, 25,000. You're going to make 1%, so $250. In 5 million, that's $50,000. Same trade. Assuming all else equal, it's $50,000 versus $250. Which do you think is going to be more meaningful and keep that trader focused on trading? Obviously, the bigger account. So trading meaningful capital levels is key. It helps us, well, it not only ups our gains by multiple factors, it helps us see what can happen when we make a good trade. And what does that do? That makes us want to study and become even better. So this is huge, and this is how prop trading really has taken off, because there are a lot of firms out there with a lot of capital behind them that want to profit share with great traders because they've seen what great traders can do. I didn't know if I mentioned it earlier, but the statistics on percentage of retail traders or traders that try to trade alone and just try to go at it by themselves, 95% failure rate. And it has to do with all these things I've been talking about. That's a huge number. Well, how many of those might have been successful had they just done, taken care of these 5 things? So most traders lack sufficient capital to make enough money to justify the time they spend trading. So like I said, guy makes $500. It's not justifying him quitting his job or spending, a few more hours a day studying on how to become better. It's just the payoff isn't worth the trouble and the work it takes to get good. Because of this, they take more risk than they should. How many people do you know that do that? I've known several traders that do that. So an adequately funded trader can trade for the sake of a good trade and nothing else. And that is so true. Because a good trade is going to make enough to justify all the work that goes into making a good trade, a sound trade. Not gunslinging, risking it all on red, so to speak. None of that. So in conclusion, these are the 5 top reasons why retail traders fail. I also call them the solitary trader. And like I said, Paragon can help you solve all of these. We are a community of traders. We talk a lot. The coaches are great. You get with your coach a lot. And all of this gets worked out. And that's all I have on this, and we'll talk to you soon. Bye-bye.